Now speaking, Julie Stewart, Vice President, Investor Relations. Good morning everyone, thank you for joining us. Joining us today are our CEO, Ed Bastian, President, Glenn Hauenstein, and CFO, Dan Jahnke. This quarter Delta reported strong performance across a number of key areas. Ed will provide an overview of our performance and strategy, Glenn will give an update on the revenue environment, and Dan will discuss costs in our balance sheet. Delta reported total revenue of $10.6 billion, excluding special items, up 14% year-over-year. Our cost per available seat mile, CASM, was down 7%, while our pre-tax margin came in at 10.4%. We also saw improvements in our cash balance, ending the quarter with $9.3 billion in cash and short-term investments, up from $6.8 billion at the end of March. Looking ahead, we anticipate continued revenue growth, as well as further improvements in CASM and our pre-tax margin. We remain confident in our ability to deliver long-term value to shareholders and customers alike. Now speaking, Ed Bastian, Chief Executive Officer. Good morning everyone. Delta reported record revenue and earnings in the June quarter, with earnings of $2.68 per share, a 90% increase over last year. Revenue was 19% above last year, resulting in an operating income of $2.5 billion, bringing our operating profit over the last 12 months to $6 billion. We generated over $1 billion of free cash during the quarter, bringing our first half free cash flow to $3 billion. Delta is beyond recovery and firmly on a great path forward, evidenced by the reinstatement of a quarterly dividend signifying strong execution on our 3-year plan. Our people continue to deliver for our customers, resulting in the Points Guys ranking of Delta as the best U.S. airline for the 5th year in a row. We shared our success with our team by providing eligible employees with a 5% pay increase in April. Year to date, we have accrued over $660 million in profit sharing, more than the total profit sharing paid out for full year 2022. The industry backdrop remains constructive, with air travel demand strong and consumer financial shape good. We are raising our full-year outlook and now expect earnings of $6 to $7 per share. For the September quarter, we expect double-digit revenue growth of mid-teens operating margin and earnings of $2.20 to $2.50 per share. As we move to 2024 and beyond, our strategy positions Delta well for the future, with a focus on free cash flow, return on invested capital, and earnings durability. We expect to generate over $10 billion of free cash flow from 2023 to 2025, and our 2024 earnings target is over $7 per share. Now speaking, Glenn Hauenstein, President. Good morning. Delta had a record June quarter with revenue of $14.6 billion, up 19% over last year. All segments performed well, with consumer demand, business travel and loyalty driving revenue growth. Premium revenue grew 25%, while unit revenues increased 1.3%. Remuneration was 22% higher year-over-year. For the September quarter, total revenue is expected to be similar to 2Q, increasing 11% to 14% year-over-year. Unit revenues are anticipated to be 2% to 4% lower due to tougher international comps. Domestically, demand remains robust and corporate travel is expected to increase in the second half. Capacity growth is anticipated to normalize to mid-single digits in 2024, allowing Delta to further improve reliability and efficiency to reduce costs and support margin expansion. Now speaking, Dan Jahnke, Chief Financial Officer. In the June quarter, Delta delivered earnings of $2.68 per share and an operating margin of 17%. Non-fuel unit costs were down 2.4% year-over-year and fuel prices averaged $2.52 per gallon, including a refinery benefit of 4 cents. Operating cash flow was $2.6 billion and free cash flow was $1.1 billion after reinvesting $1.6 billion into the business. Delta repaid $3 billion of debt during the first half of 2023 and is on track to repay over $4 billion of gross debt this year, resulting in interest costs over $100 million lower than expectations. The company's leverage ratio improved to 3.2 times and Delta reinstated a quarterly dividend. For the September quarter and full year, Delta expects mid-teen operating margins and earnings of $2.20 to $2.50 per share with non-fuel unit costs declining 1% to 3%. Fuel prices are expected to be between $2.50 to $2.70 per gallon, including a 4 cents refinery benefit. The company now expects the full-year earnings to be $6 to $7 per share, an operating margin greater than 12%, and free cash flow of $3 billion. Leverage ratio is expected to reach 3 times by the end of the year and return on invested capital is projected to be 14%. Cowen and Company analyst Helen A. Becker inquired, Dan, did you say $4 billion in free cash flow is the new guidance? Please explain how you are balancing customer-facing tech investments with back-office needs. Dan Jonke replied, in answer to the question about free cash flow for 2023, we are projecting $3 billion this year as part of our 3-year plan to reach $10 billion. We anticipate $4 billion or more in 2024. Ed Bastian replied, Helene, I mentioned at our investor day that digital is one of our most important investments. We're making progress but still have more to do. Most of the work is within our Capex run rate and should start to be completed by the end of 2024, creating more capacity with our existing budget for digital. Morgan Stanley analyst Ravi Shankar inquired, Glenn, could you expand on your comments about the fall and provide us with an update on U.S. domestic demand? Glenn Hauenstein replied, we are seeing high demand across the board, domestically and internationally. We anticipate this trend to continue until late October. Domestically, we have seen growth in the June quarter and more positive trends as the summer progresses. We are encouraged by these developments. Morgan Stanley analyst Ravi Shankar inquired, Ed and Dan, what financial targets are you aiming for in the long term to build on your success of hitting your EPS target of $7 this year? Ed Bastian replied, Ravi, our goal is to hit $7 in revenue before we can talk about any further expansion plans. Ed Bastian replied, we anticipate increasing our current year guidance. We plan to have a conversation about our long-term financial targets during the first half of the upcoming year. Our immediate focus is delivering the best possible experience for our customers. We look forward to providing further updates on our EPS over the course of the next 12 months. Goldman Sachs analyst Catherine O'Brien inquired, can you explain the deceleration in RASM for 3Q compared to 2Q, and what role is airfare CPI playing? Glenn Hauenstein replied, we use a sample of a sample methodology, which can result in variances from what you're seeing. We can forward the definition of this method to you if desired. Ed Bastian replied, last May and June, we saw a surge in demand with low supply. Fares skyrocketed to 30%, 40%, and 50% higher than normal, particularly in domestic markets. Now, we're seeing more stability in the fare environment domestically. Comparing one CPI print from a survey to Delta's future is an inaccurate comparison. Goldman Sachs analyst Catherine O'Brien inquired, Dan, do you anticipate free cash flow exceeding your $3 billion target? If so, is there potential to exceed your $4 billion debt paydown goal? Dan Jonke replied, certainly, our priority is to pay down debt and generate cash. We anticipate that in the back half of this year we will exceed our goal of $4 billion gross debt paydown. Our team has been working hard on reducing debt through open market repurchases and other activities, and we plan to continue doing so. Deutsche Bank analyst Mike Linenberg inquired, can you explain what is driving the extended season for European markets and what impact does international travel have on domestic load factors? Glenn Hauenstein replied, in terms of seasonality, we've extended many seasonal deferrals due to our maintenance approach. We strive for a full summer season in most markets, with Southern Europe seeing a longer season than before and Northern Europe having a shorter season. We're taking advantage of these new travel patterns and aiming to create a network that produces the best returns all year round. Our domestic portion of international journey is around 10%, including Caribbean and Mexico. If you exclude those short hauls, the number would be lower. Jefferies analyst Sheila Kahyaoglu inquired, what cost benefits are contributing to the 100 basis points improvement in margin guidance for 2023? Are you assuming some yield strength from Atlantic and domestic hubs restoration? Dan Jonke replied, yeah, non-fuel sales were up in the first half and are projected to be down low single digits in the second. This combined with fourth quarter versus first quarter performance contribute to the margin improvement. Jefferies analyst Sheila Kahyaoglu inquired, what is the Capex assumption and what is the expected aircraft delivery skyline for the year? Dan Jonke replied, yes, we've maintained our even cash flow this year as we increased it from 2 to 3. Our capital expenditure has remained at 5.5 and we are still targeting a fleet size of 42 to 43 aircrafts for the year. However, this number could fluctuate slightly over the course. Wolfe Research analyst Scott Group inquired, Glenn, can you provide more detail on the adjustments contributing to 3Q's RASM being in line with seasonal expectations? Also, what are the domestic and international RASM projections for the quarter? Glenn Hauenstein replied, on the seasonality between 2Q and 3Q, we had some day shift impact with 4th of July being in 2Q. We're about a point off our normal level, but if you look back to last year, it was right in line with the seasonal norms. Last year, international RASM was up 16 points due to travel restrictions being lifted in 2Q. We are expecting similar results this year. Wolfe Research analyst Scott Group inquired, could you provide an outlook for the expected inflection in CASM in the first half of next year? Dan Jonke replied, we expect next year's capacity growth to be in the mid-single digits, while scale and efficiency gains will offset a portion of the costs associated with the continued wage increases for our pilots. This framework should result in cost increases, overall, in the low single digits. JP Morgan Chase & Company analyst Jamie Baker Inquired, Glenn, does your third quarter RASM guide factor in any market share gains from competitors changing their distribution strategy or leaving the Northeast? Glenn Hauenstein replied, in terms of the NEA, I think it's just part of competition and we're looking forward to continuing to compete in New York. Our third quarter is largely based on the same strategies as the second quarter, with no changes to our distribution plans. Our history of success in New York spans 10 years, and we remain confident that we will continue to win in the market despite any changes to the competitive landscape. The cessation of the NEA is simply part of the competition, and we are prepared to continue competing for business in New York. J.P. Morgan Chase & Company analyst Jamie Baker inquired, what shifts have been seen in customer feedback from individual sectors over the past quarter? Glenn Hauenstein replied, I believe that the reopening of offices and increased travel will be a great boon for our company. We have seen that in the past, when people return to work, our business experiences an uptick. Ed has always said that our success is tied to office occupancy, and we are seeing that assumption come true as more offices open up. This should lead to a positive outcome as we move into the post-Labor Day period. Ed Bastian replied, Jamie, I'd like to emphasize that our economy is larger than it was in 2019. This means there's room for improvement and growth for corporate travel. We're expecting to see steady improvement going into the fall. Travel managers have confirmed this. Melius research analyst Connor Cunningham inquired, can you provide clarity on the potential upside of corporate travel recovery for the back half of the year? Glenn Hauenstein replied, we have seen a gradual and consistent increase in our guidance. If it were to surpass its current performance, that would be a positive upside. Melius research analyst Connor Cunningham inquired, could you please explain what drove your domestic RASM outperformance compared to your peers? Glenn Hauenstein replied, premium products and services have led our business this quarter. We made investments in coastal gateways earlier which are now producing good returns, and we're now investing back in the core, yielding higher unit revenues. These two factors are pushing us forward. Raymond James analyst Savvy Seith inquired, what domestic and international capacity growth trends do you expect in the near future? Glenn Hauenstein replied, as capacity trends decrease, we anticipate a more even distribution between domestic and international going into 24. We do not yet have any guidance on that as our internal 24 plan has not been finalized. Raymond James analyst Savvy Seith inquired, Glenn, could you provide more insights on the performance of the Latam entity broken out between near and international markets? Glenn Hauenstein replied, yes, we've been really pleased with our performance in Latin America. We have seen a steady increase in revenue in the region, especially in short and medium haul markets. Although not as dramatic as earlier in the recovery, this region continues to show strong growth. Evercore IC analyst Wayne Fenningworth inquired, could you please provide an update on what new approaches or learnings you have taken away from the transatlantic JV during the pandemic which will change how you operate in the future? Glenn Hauenstein replied, we have a successful transatlantic joint venture that has been consistently evolving with our partners. We've seen some flight swaps in the past few months, and while there haven't been any drastic changes, it's always a work in progress. Evercore IC analyst Dwayne Fenningworth inquired, what is your view on normal seasonality for ASMs in July, August and September? Glenn Hauenstein replied, we're seeing a more normalized seasonality this year. Schools in the South, such as Georgia, are going back earlier this year than usual, August 1st. This has resulted in the summer travel period ending earlier in the South due to the schools starting. Meanwhile, in the North, the schools are starting after Labor Day, which will result in the northern tier operating a little longer before pulling down after Labor Day. We have now returned closer to our desired seasonality. Barclays analyst Brandon Oglenski inquired, Glenn, given the full-year guidance, is the implied revenue in 4Q softer than 3Q due to booking trends and lack of cancel fees that have changed consumer behavior? Glenn Hauenstein replied, I believe at this point, we are still gathering information to get a better view of the 4Q results. As we move closer to the end of the quarter, we will have more clarity that we can share during our October earnings. Barclays analyst Brandon Oglenski inquired, can you explain how you are structuring the off-peak periods differently this year than prior? Glenn Hauenstein replied, given the seasonality of our business, we anticipate strong performance from October through December. We have good bookings for the holidays and are confident that we will see increased travel during this time period. Our visibility gives us good insight into how the rest of the year will unfold, and there's potential upside if corporate travel returns more than expected. Air travel reporter Allison Sider inquired, can you speak to any potential issues with Delta's free Wi-Fi plans due to Viasat's recently reported satellite deployment issue and if alternative solutions must be considered? Ed Bastian replied, hi, Ellie. We were disappointed by yesterday's news but remain committed to Viasat long-term. Our domestic capacity remains unchanged and we are working with them closely to ensure performance remains great. The news may cause a delay in the international rollout, though it is too early to tell. Air travel reporter Allison Sider inquired, what is Delta's view on Congress' proposed simulator training counting toward pilot experience hours? Peter Carter replied, hey, Allison. It's Peter. Delta has not commented on those proposals. Our pilot training is highly effective and critical to maintain. Airline reporter Leslie Josephs inquired, could you please provide an update on Delta's view on raising the pilot age and any changes to day policies in light of last month's ruling? Glenn Hauenstein replied, Leslie, we don't have an opinion on that. There are varying viewpoints within the pilot community on this subject. We'll observe how the discussion unfolds and Peter will touch on affirmative action. Peter Carter replied, hello Leslie, at Delta we are fully committed to our D&I objectives and we only hire the best. We don't have an affirmative action program. Airline reporter Mary Schlangenstein inquired, what steps are you expecting for corporate travel recovery this fall and do you anticipate any decline in leisure travel when schools return? Glenn Hauenstein replied, we are seeing strong leisure demand for international travel post-Labor Day that should continue through October. We are hopeful that we will see an uptick in business travel, but we are not basing our projections on that expectation. Senior aviation business reporter David Slotnick inquired, what are Delta's contingency plans for the potential legislation that would affect credit card fees and charges? How will Delta make up for any losses if this legislation is passed? Peter Carter replied, hey David, it's Peter. We're closely monitoring the legislation, and if it is passed, we'll make adjustments as needed. We don't believe it will become law. Julie Stewart replied, thank you for joining us today. The outlook for our business is strong and we look forward to a successful October quarter. We are confident that our strategies will continue to